Hi, how you doing? This is Stu Simone with Rock Real Estate. It's time to talk about the I word. As the curtain fell on the historic real estate year of 2021, inflation suddenly reared its ugly head. With the highest inflation rate since spandex-clad hairbands roamed the earth in the late 20th century, many homeowners and real estate investors are wondering what this means for them and their most important asset, their property. The effect of inflation can be easy to spot in consumer goods. How about that cost of gas, huh? But what effect does inflation have on real estate? Well, unlike the price of milk, the effects on real estate are a lot more complex. So let's take a closer look at the role of inflation on real estate assets, mortgages, and how home buyers, sellers, and investors should position themselves in a high inflation environment. First off, what is inflation? Well, inflation refers to a decrease in the purchasing power of money, reflected in an increase of the price of goods and services in the economy. So, as inflation ticks up, every dollar you earn loses value and then therefore impacts your ability to spend. Thanks to the COVID pandemic, we suffered through housing market inflation due to low supply from cautious homeowners, coupled with high demand fueled by record low interest rates. And now, as 2022 begins, it appears that inflation has hit the entire economy, not just the housing market. So let's take a deep dive into the swamp and see what all this means for you, the property owner. Number one, inflation can lead to higher mortgage rates. Generally speaking, as inflation increases, so too do interest rates. That's mainly because as inflation goes up, central banks typically raise short-term rates to put a downward pressure on the inflationary environment. If interest rates are low, as they have been, more consumers tend to borrow, which means they have more money to spend. And that eventually moves inflation higher. So central banks then raise the interest rates to fight off the inflation, believing that consumers will tend to save more rather than spend because returns from higher interest rates are more appealing. No more 1% CD accounts. So in late breaking news, Freddie Mac has just announced that mortgage rates have jumped by nearly 0.5% in the first 2 weeks of the year, 2022. And this is without any change in interest rates by the Fed. So sadly, it seems pretty clear that the all-time low interest rate seen in January of 2021 is a thing of the past. Most experts say that rates are likely to continue moving higher as the market adjusts to two new realities. One, inflation is currently at the highest rate in 4 decades. Higher inflation means higher interest rates. That's because bond investors need to charge higher interest rates to compensate themselves for their investment losing value relative to the inflation rate. And if inflation stays elevated, it's very likely that interest rates will continue to move higher. Number two, the Fed has injected a staggering $4.6 trillion into the economy since March 2020, and now these programs are coming to an end. In November 2021, the Fed hinted there might be several interest rate hikes in 22, and in recent weeks suggested it will end its stimulus programs in early 22 and start shrinking its balance sheet shortly thereafter. This means the Fed may start to unload its massive bond holdings into the market, which would drive up bond supply and interest rates in the months ahead. Number two, inflation can lead to higher real estate prices. Generally speaking, when inflation increases, then housing and other real estate asset prices follow suit. But that said, when mortgage rates rise, the demand for real estate lowers because debt becomes more expensive, and less demand means lower prices. What makes 2022 different is that the inventory of homes for sale is still near all-time lows. So even if demand falls, that downward pressure may not be felt much, if at all. So the bottom line, an inflationary environment has an unpredictable effect on prices, as some factors will lower values while others raise them. So let's dig into the weeds for some of the subtleties here. Now for the good, the bad, and the ugly, as in ugly houses. Good news for homeowners and many real estate investors. Have you heard the term good debt? Well, inflation can be good news for anybody holding debt, such as a mortgage or a construction loan. If you paid cash, sorry folks, but if you're holding debt, your existing debt becomes cheaper as inflation increases because the relative cost of your debt goes down every time inflation hits. So if you bought or refinanced, say at 3%, and inflation historically is also 3%, you can look at that as cost-free money. But if inflation is 6%, the cost of your debt is even less because your property value appreciated 3% faster than your loan rate. Now, there's some bad news for flippers and rehabbers. Because things get more expensive with inflation, the cost of materials used in construction will also rise. And inflation not only boosts machinery costs and building materials, but also the cost of labor. It also puts developers and investors in a scenario where cost overruns are much more possible. Thus, if you believe that inflation is here to stay a while, it'd be wise to factor inflation costs into your calculations. Now, there's good news for homeowners and residential real estate investors. The good news for buy and hold investors is that real estate tends to outperform other investment classes in inflationary environments. And I would add that COVID has added a new wrinkle in that office space is in less demand as more people work from home. So residential real estate seems like the best bet. After all, everybody needs a place to live, right? And now some of them are working there as well. Now, back to bad news for renters and landlords in rent-controlled areas. Studies have shown that historically high periods of inflation also saw a similar increase in rent prices, which makes sense. But buy and hold investors had to be on their toes during inflationary times. If a landlord doesn't raise rents or can't raise rents to match the rate of inflation, they are taking a loss that is compounded over time. So sometimes the rent control increases are only 3% per year total, max. Now back to good news for anyone owning real estate. Given that under most circumstances, an inflationary environment leads to higher rents and higher asset prices, real estate is considered to be a great hedge against inflation. Remember the three positives we outlined earlier. Number one, the value of your property rises with inflation. Number two, the debt on your asset is devalued as the value of that debt decreases with inflation. And number three, and good news for landlords, rents rise with inflation. That said, real estate investors still need to be careful in high inflation environments, primarily because the cost of borrowing will increase, putting downward pressure on your cash flow and demand for real estate if you want to liquidate. Flippers suffer a double whammy as construction costs soar while buyer demand weakens. For homeowners who are moving, as I always say, if you're selling one home and buying another, whether the prices are high or low, it ends up being a wash. While it's the interest rate on the new home that really matters. So pay attention to those rates. Don't wait too long. Now, for real estate investors currently owning real estate, inflation is generally a good thing as long as you remember to increase your rent to keep pace with the inflation rate. For prospective investors, it's a little more tricky. The most important factor this group must consider is timing. Ask yourself, how long do you plan to own the prospective property? If you're in it for the long haul, you should expect the same value increases that existing homeowners are experiencing. But if you are a flipper or rehabber, then you need to be cautious. One of the dangers of short-term investing in an inflationary real estate market is the risk of getting caught in a real estate bubble. Now, for all investors, an inflationary environment can definitely be positive as long as you make smart acquisitions. Remember, the profit is made at the purchase. And stress test your portfolio against inflationary pressures such as rising interest rates. Now, one last comment. I've been hearing from a number of homeowners that they are waiting to move until the prices come down. Well, as you know now, this is probably a bad strategy as it is extremely likely that interest rates will continue to rise. Right now, you have the best of both worlds. You have low rates still and high selling prices. So don't miss out on this opportunity to move or do a cash out refi, as cash may never be this cheap again. Don't let your equity just sit there collecting the proverbial dust while you can have money to spend, perhaps invested in some real estate at just 3% interest. Just saying. Anyhow, thanks for watching, and please check out our other highly educational and mildly entertaining videos here at Rock Real Estate.